We spent a lot of time exploring factors, and let's just review them real quick. There's the market factor, also called the equity risk premium, the size factor, also called the small cap factor or small cap risk premium, the price factor, also called the value factor or value risk premium, profitability factor, investment factor, and on the fixed income side, we also learned that the longer term bonds should deserve a term premium because you're taking on interest rate risk, the risk that if interest rates go up, the bond prices fall. And we measure that risk by the concept of duration. Duration is a calculation that takes into account the cash flows received from that bond over time and the uh, the current market environment in terms of the interest that's being paid and any changes in those interest rates that might occur. Credit risk or default risk of bonds is also a big thing. If you have a bond with a lower credit quality, then you're should be rewarded for basically taking on the risk of a bond that's more likely to default, where you don't get back all of the interest payments that you deserve on your principal amount. Academic research has looked at these factors and found that they are pretty pervasive. They're pretty robust. Not all of them are as robust as some of the others that are listed here, but they're all pretty well accepted in the academic community. There are some other factors that we haven't studied and we're not studying in this course. For example, quality factor, which seems to be a combination of some others, the carry factor and some others. Uh, but these are the main factors that are seen nowadays in the world of investing. A couple more like low volatility and the like. Where do all these factors come from? They come from academic research. The single factor model, which is basically exposure to the stock market, the equity risk premium, has been around for a very long time. You can actually go back to some papers back in 1963. The size factor, the small cap factor, 1981. The value factor, 1991. And remember back in 1992, Professors Eugene Fama and Kenneth French did a paper that kind of synthesized these three factors. And what they found is that about 95% of the returns of a portfolio, if it's a diversified portfolio, are likely to be explained away by the exposures of those portfolios to these factors. We also have the profitability factor, a much more recent factor, and the investment factor as well. What type of stock is this? We have just a comparison to the S&P 500 index. This is Microsoft. Actually, a couple of years ago, Microsoft is valued more highly right now. And we compare that to another large company called JP Morgan Chase. So S&P 500 index, which is an index of large cap stocks, is at the top, just as a benchmark for comparison purposes. We see that Microsoft has got a pretty high price to earnings ratio and a pretty high price to book ratio compared to JP Morgan Chase, which has got a lower price earnings ratio and much lower price to book ratio. Banks in general have to maintain a lot more capital. And we can also look at this from the standpoint of small company stocks. The Russell 2000 index, the average market cap is about 787 million at the time this slide was done. And we look at a couple of companies you probably never heard of that are considered small companies. One has a PE ratio that's really low, and compared to one that has a fairly high PE ratio. It's actually moderate, but it's still less than that of the S&P, the Russell 2000 index at the time. The price book ratios, this one's got Danos has got a really low price to book ratio compared to Investnet, which has got a higher. How do we classify those? Well, if we look at what Morningstar called them at the time, Microsoft is a large growth company. JP Morgan is a large value company. Danos Corporation is a small value company, and Investnet could be considered either value or growth or something in between. We might call that core, or if we were holding a small cap fund, we might call it a balanced fund if it included all of the funds out there. You can actually go to Morningstar and look up a stock, and Morningstar will actually classify that stock for you. There are other ways of classifying stocks. Morningstar does it one way. Mutual fund managers can use a lot of different valuation metrics to classify those. So let's just take a minute here and perhaps watch a YouTube video